A study published by Hartford Funds tracked dividend paying stocks going back to 1973. Over that entire stretch, 5 decades, multiple recessions, 2 market crashes, dividends accounted for roughly 40% of the total return of the S&P 500. Not price appreciation, not timing the market, just the quiet, compounding effect of companies sending cash to shareholders, year after year, whether the market was up or down. Most people see that number and think, retirement strategy, something you set up in your 60s when the real work is done. But that framing has quietly shifted, and the investors paying attention are building income streams in their 30s and 40s that their salaries can't compete with. So here's the question worth sitting with. If dividends can genuinely replace a paycheck, why do so many people who try end up worse off than when they started? That's what this video is about. There's a specific mathematical trap built into how dividend yields are calculated. And if you don't see it coming, it doesn't just slow you down. It actively erodes the capital you put in, quietly, while looking like it's working. My name is Alex, and if you've ever looked at a high-yield stock and wondered why everyone isn't just parking their savings there, stay with me. Because the answer changes everything about how you build a portfolio. I'm going to show you exactly how the yield calculation works against you and how to construct income that actually holds. Once you understand the math behind the money, you stop chasing yield and start building it. Before we get into the mechanics, let's make the destination concrete, because passive income is one of those phrases that gets thrown around so much, it stops meaning anything. So let's put actual numbers on it. Marcus is a 29-year-old teacher in Columbus, Ohio. He's not a Wall Street guy. He doesn't have a finance degree. But 3 years ago, he opened a brokerage account and started putting aside $400 a month into dividend-paying assets. Last month, his portfolio sent him $41. Not from a second job, not from selling anything, just because he owned assets that paid him while he slept. $41 doesn't sound like much. And honestly, right now, it isn't. But that moment, the first time you receive money you didn't directly trade your time for, does something to your thinking. It makes the whole thing feel real in a way that a spreadsheet projection never quite does. It shifts the question from, is this possible, to how far can this actually go? Here's how far it can go. Think of it as a ladder. Each rung represents a milestone, a point where your dividend income starts covering a recognizable slice of your life. At $10,000 invested, yielding around 4%, you're generating roughly $400 a year. That's your streaming subscriptions, your monthly phone bill. Small, but it's real money your portfolio is now handling. Push that to $100,000, and the math starts getting interesting. At the same 4% yield, that's $4,000 a year, or about $330 a month. Currently, the average American household spends roughly $320 a month on groceries. Your portfolio is now feeding you. By the time you're sitting on $300,000 in income-producing assets, you're generating around $12,000 a year. That's a monthly rent payment in most mid-sized American cities, not covered by your salary, covered by assets you built. And here's where the ladder leads if you stay on it. At one point, $5 million invested at a conservative 4% yield, you're pulling in $60,000 a year. That lands comfortably above what the Social Security Administration currently lists as the average annual retirement income for an American retiree. You've replaced that number entirely, and without touching the principal. The $1.5 million keeps sitting there, still growing, still paying. That last part matters more than people realize. Most income strategies require you to sell something eventually. You draw down the account. You eat into the principal. The clock is always running. A well-constructed dividend portfolio doesn't work that way. The asset base stays intact. The income keeps coming. You're not spending the mountain. You're living off what the mountain produces. Now, I want to be straightforward with you here. Getting from Marcus's $41 to $60,000 a year is not a weekend project. It takes time, consistency, and, this is the part most people skip, an understanding of how the underlying math actually works, because the ladder is real. But some serious shortcuts look like they'll get you there faster and will actually send you sliding back down. And the most dangerous one hides in plain sight. It's a number every dividend investor looks at first, the yield percentage. And it can be deeply misleading if you don't know what's actually driving it. That's exactly what makes the yield trap so costly, and it's where we need to go next. Here's something that stops most people cold when they first see it. The same $60,000 a year in dividend income can require wildly different amounts of capital. depending entirely on one number. And that number is yield. Let's run the math slowly, because this is where the whole strategy either clicks or falls apart. Say your goal is $50,000 a year in passive income, enough to cover rent, groceries, utilities, and still have breathing room. A real, livable income replacement. Now look at Apple, one of the most recognized companies on the planet. Rock-solid balance sheet, hundreds of billions in cash reserves. Sounds like exactly the kind of thing you'd want in a dividend portfolio. But Apple currently yields around 0.39%. That means for every $10,000 you invest, Apple sends you about $39 a year. To hit $50,000 annually at that yield, you'd need to have $12.8 million invested. That's not a portfolio. That's a different life entirely. Now look at Pepsi. Not as exciting, nobody's putting Pepsi on a tech podcast. But Pepsi currently yields around 3.8%. At that rate, the same $50,000 income target requires $1.3 million invested. Still a significant number? We're not pretending otherwise. But that's 10 times less capital than Apple demands for the identical payout. Same destination, 10 times less money to get there. That's not a small difference. That's the entire game. And this is where yield stops being an abstract percentage and becomes the most important number in your strategy, because it doesn't just tell you what a stock pays. It tells you how hard your capital has to work. A low-yield portfolio forces you to accumulate an almost unreachable pile of assets before the income becomes meaningful. A thoughtfully chosen higher-yield portfolio lets the math work in your favor much earlier. Think about what that compression actually means in human terms. The difference between needing 1.3 million and needing 12.8 million isn't just a number on a screen. It's roughly a decade of additional saving, compounding, and waiting. It's the difference between pivoting your financial life in your mid-40s versus your late 50s. Yield is not a detail. It's the variable that sets your timeline. Now here's the opinion I'll offer directly. Most people building their first portfolio don't think about yield at all. They buy what they recognize. They buy what feels safe. They end up with a collection of great companies that happen to be nearly useless as income generators. And then they wonder why the passive income never quite arrives. Rachel is a 41-year-old marketing director in Denver who spent 7 years building a portfolio she was genuinely proud of. Strong companies, solid growth, good diversification. When she finally sat down to calculate the income it was generating, it came to about $11,000 a year on a portfolio worth just over $600,000. She wasn't doing anything wrong by growth investing standards, but she wasn't building income. She was building appreciation, and those are two different strategies with two very different timelines. Understanding yield is what separates those two paths. But here's where it gets dangerous, because once you see this math, the instinct is immediate. Just find the highest yield available and let it do the work. And that instinct, completely logical on the surface, is exactly what leads investors into the yield trap. There's a version of this story that ends badly, and it starts with a perfectly reasonable question. If a higher yield means you need dramatically less capital to hit your income target, why not just find the highest yield on the market and let it run? 20%, 23%. Some of these things exist. Why isn't everyone doing exactly that? The answer is in how yield is actually calculated. And once you see the mechanism, you can't unsee it. Yield is a fraction. The annual dividend divided by the current share price. That's it. Which means yield doesn't just go up when a company raises its dividend. It also goes up, automatically, mathematically, when the share price falls. A stock paying $2 a year in dividends at a share price of $40 yields 5%. That same $2 dividend at a share price of $20 yields 10%. The dividend didn't change. The company didn't get more generous. The price just collapsed, and the yield doubled as a result. This is the yield trap, and it catches people who are doing exactly what the math seemed to suggest. When a company starts struggling, revenues falling, debt rising, business model cracking, investors sell. The share price drops, and as it drops, the yield climbs. From the outside, it can look like an opportunity, a high-paying stock at a discount. But what you're actually looking at is a distress signal dressed up as an attractive percentage. Look at what happened with PNNT, Pennant Park Floating Rate Capital, over the last decade. On paper, the yield looked exceptional. The kind of number that makes you stop scrolling. But over 10 years, the actual dividend payout shrank by 75%. The income you were counting on quietly disappeared, quarter by quarter, and the share price dropped an average of nearly 5% every single year. Someone who put $100,000 into this didn't build an income stream. They watched their investment shrink to around $64,000 while receiving less and less cash along the way. They didn't buy income. They funded the slow erosion of their own capital. And I want to be clear about something here. This isn't a fringe example. This pattern repeats across the market, reliably, in every cycle. What makes it worse is that even a famous brand name offers no protection. James is a 47-year-old logistics manager in Cincinnati who built a significant position in what he called the untouchables, companies like 3M, AT&T, and Walgreens, household names, decades of consistency, the kind of stocks that felt like a sure thing because they had always been a sure thing. Then 3M cut its dividend, a T&T cut its dividend, Walgreens cut its dividend. Some of these companies had maintained or grown their payouts for 40 to 60 consecutive years before the cut came. One bad strategic pivot, one deteriorating business model, and the income stream James had built his retirement timeline around was suddenly 30 to 60% smaller than he'd planned for. The yield was never a guarantee. The underlying business was. And when the business stopped growing, the dividend followed. So if blindly chasing yield is a trap, and even trusted brand names can let you down, how do you actually build a portfolio that generates reliable income without blowing up? The answer isn't a single stock or a single sector. It's a framework. And building your income portfolio the right way means thinking in layers, not bets. Most people approach portfolio building the way they approach buying a car. They pick the thing that looks best on the surface, check the price, and make a decision. But a reliable income portfolio doesn't work like a single purchase. It works like a building, and buildings need a foundation before they get walls. The framework that makes the most sense here divides your capital into 4 distinct layers, each one carrying a different level of risk and a different role in the overall structure. You don't pick one. You blend them, and the blend depends on how much capital you have and how much volatility you can genuinely stomach when markets turn ugly. The base layer is your foundation. Cash equivalents and treasury bills are currently yielding around 3.5%. This is the part of your portfolio that never surprises you. It doesn't grow aggressively, but it doesn't collapse either. In a market panic, this is what lets you sleep. Every income portfolio needs some of this, not because it's exciting, but because stability at the base is what allows you to take calculated risks higher up. The second layer is where you start building real income with manageable risk. Blue chip dividend ETFs, funds like SCHD, which tracks a basket of high-quality U.S. dividend payers, currently yield around 3.8%. These are companies with strong free cash flow, consistent payout histories, and enough business resilience to keep sending checks through a recession. This layer is your core engine. It won't make you rich overnight, but it compounds quietly and reliably over the years. The third layer is where cash flow accelerates, and where you need to pay close attention. Covered call ETFs like QQQI currently advertise yields north of 14%. That number is real, but the mechanism behind it is not what most people assume. These funds generate income by selling options contracts on the stocks they hold. The yield is genuine, but there's a catch called return on capital, or ROC. Some of what gets paid out isn't actually income generated by the portfolio. It's your own money being handed back to you, repackaged as a distribution. It feels like income. It isn't always. And if you don't track it carefully, you'll end up with a shrinking asset base while thinking you're getting rich. The fourth layer is the most speculative. Assets like crypto-linked instruments currently yield around 11.5%. These belong at the outer edge of the portfolio, a small allocation for investors who understand the risk and can afford to be wrong. Not a foundation, not even a wall, more like a weather vane. Useful in the right conditions, dangerous if you build your roof around it. Now let's make this concrete. Say your goal is to cover $2,000 a month in rent entirely from dividend income. At Realty Income's current yield of around 5.2%, you'd need roughly $460,000 invested to hit that number. Extremely stable. Realty Income has paid and raised its dividend for decades, but it demands serious capital. Step up to Main Street Capital at around 8.5%. a business development company that held its dividend through the 2008 financial crisis, and that same $2,000 a month requires closer to $280,000. Move further up the risk ladder to CSWC at nearly 11%, and the capital requirement drops again. But the ride gets meaningfully rougher when credit markets tighten. The right blend isn't the same for everyone, but the structure is. Stability at the base, growth in the middle, carefully sized risk at the edges. And once the portfolio is built and generating income, there's one more variable most investors completely overlook: how much of that income they actually get to keep. That's where the zero tax secret comes in. Most conversations about dividend investing stop at the yield. How much does it pay? How much capital do you need? How do you build the portfolio? But there's a number almost nobody talks about in the same breath, and it might be the most important number in the entire strategy: zero. That is the federal tax rate you can legally pay on qualified dividend income if you structure things correctly, not a loophole, not a gray area, a straightforward feature of the current U.S. tax code that most investors either don't know exists or don't understand well enough to use. Here's how it works. This year, if you are a single filer and your total taxable income, including your dividend income, stays below $49,450, your federal capital gains tax rate on qualified dividends is 0%. Married filing jointly, that threshold sits at around $98,900. Below those lines, the IRS takes nothing from your dividend income at the federal level. Let that land for a moment. A $40,000 dividend stream replacing a $40,000 salary. With the salary, you lose roughly a third before it ever reaches your account: federal income tax, state tax, Social Security, and Medicare. You earn $40,000 and you take home somewhere around $26,000 or $27,000. With qualified dividends structured below that threshold, every dollar goes directly into your pocket. Same number on paper, completely different outcome in reality. Consider what this means for someone like Diana, a 44-year-old nurse in Nashville who spent 15 years building a dividend portfolio alongside her regular income. As she approached the point where her portfolio could realistically replace her salary, she worked with a tax advisor to map out the transition carefully. By retiring from full-time work and living on $42,000 a year in qualified dividends, she dropped below the 0% threshold entirely. Her federal tax bill on that income? Nothing. The portfolio she'd spent 15 years building was now generating a take-home income that her working salary, after withholding, never actually matched. Now here's the part that doesn't get mentioned enough. Not all dividend income qualifies for this treatment. To be taxed at the 0% rate, dividends need to meet the IRS definition of qualified, generally meaning they come from U.S. Corporations or eligible foreign companies, and you've held the stock for a minimum period around the dividend date. Most standard dividend ETFs and blue chip stocks clear this bar without issue. But the covered call ETFs we discussed in the previous section, the ones yielding 14%, often distribute a mix of qualified dividends, ordinary income, and return of capital. Each of those is taxed differently, and the return of capital portion carries its own delayed tax consequence. Here's how that consequence works. ROC isn't taxed when you receive it, which feels like a win, but it quietly reduces your cost basis in the investment. Lower cost basis means when you eventually sell, the capital gain the IRS calculates is larger than you'd expect. The tax you didn't pay today doesn't disappear. It waits, and it often arrives as a larger, more concentrated bill at exactly the moment you weren't planning for one. The tax structure of your portfolio isn't a footnote. It's part of the return calculation. Two portfolios with identical yields can produce meaningfully different after-tax income depending entirely on how they're constructed. But even a perfectly tax-efficient portfolio can work against you if the timing is wrong. And that's the tension at the center of growth versus income, which is exactly where we need to go next. Here's a question most dividend investors never ask themselves early enough. Is this the right strategy for me right now? Or just the right strategy in general? Because there's a version of dividend investing that quietly costs you more than it gives you. Not because the strategy is broken, but because the timing is wrong. And timing, in compounding math, is almost everything. This is the opportunity cost problem. And it's the part of the dividend conversation that tends to get skipped because it's uncomfortable to say out loud. Chasing income too early can genuinely delay your financial independence rather than accelerate it. Here's the mechanism: a broad total market index fund, something tracking the entire US stock market, has historically returned around 10% annually over long periods. Dividend focused portfolios, which tend to concentrate in slower growing defensive sectors like utilities, consumer staples, and real estate, have historically returned closer to 9%. 1% doesn't sound like much, but run that difference through 30 years of compounding, and it becomes a completely different conversation. Start with $200,000 at age 30. At 10% annual growth over 30 years, you end up with just under $3.5 million. At 9% over the same period, you land at around $2.65 million. The dividend portfolio left nearly $900,000 on the table, not because it failed, because it traded maximum growth for current income. And when you're 30 years old, current income is rarely what you actually need. Vanguard's research makes this concrete. Their long-term analysis shows that a total market growth strategy has outpaced dividend-focused portfolios by approximately 1% per year over extended periods. That gap is entirely explained by sector composition. Dividend portfolios are structurally heavy in value sectors that grow slowly and pay reliably. Growth portfolios hold more technology, more healthcare innovation, and more companies expanding aggressively. You're not getting a worse deal with dividends. You're getting a different deal. And that deal only makes sense at a specific point in your financial life. Take someone like Kevin, a 31-year-old civil engineer in Phoenix who came across dividend investing 2 years ago and went all in immediately. Solid research, sensible stock picks, and real income starting to come through. But when he mapped out his full 30-year projection against a simple total market index strategy, the gap was striking. By prioritizing income now, at an age when he has no particular need for monthly cash flow, he was potentially leaving somewhere between $600,000 and $1 million of compounded growth, unrealized by the time he hit 60. He wasn't doing anything wrong. He was just optimizing for the wrong thing at the wrong time. So here's the framework that actually matches strategy to life stage. Under 35, the math strongly favors total market growth. Let compounding do its heaviest lifting during the years you have the most of it. Between 35 and 40, start introducing dividend ETFs at 5 to 10% of the portfolio. Not for the income yet, but to begin learning how these assets behave through market cycles. In your 40s and into your 50s, begin the real pivot. Shift up to half the portfolio into income-producing assets as your target date approaches. By the time you're ready to stop working, the income infrastructure is already built and seasoned. The strategy doesn't change. The sequencing does. And once you understand where you sit on that timeline, one final question pulls everything together. The conclusion will show you how to find your answer. Here's what this all comes down to. Dividend investing works. The math is real, the income is real, and the ladder is climbable. But the strategy has a specific shape. And most people who struggle with it are simply applying the right tool at the wrong time, or chasing the wrong number for the right reasons, a few things worth holding on to. Yield is a fraction, not a promise. A high percentage can mean generosity or distress, and telling the difference is the whole job. The underlying business is always the guarantee, never the payout history. Tax efficiency is part of your return, not an afterthought. And the sequence of your strategy matters as much as the strategy itself. Before you adjust anything, sit with one question. Look at your current portfolio and ask honestly, is it built for the stage of life you're actually in, or the one you're romanticizing? Because the investors who get this right aren't the ones who find the best stocks. They're the ones who match their approach to their moment. There's a related question this naturally raises. What happens when you get the sequencing right, but the broader market shifts underneath you? That one's worth examining next.